Right, everyone, welcome back to the Price Action Labs YouTube channel. Here we're going to be going over a 1 of 8 part series where we're going to be dissecting footprint charts, order flow, and how you can integrate that with ICT concepts. So ICT concepts is the most popular way to trade currently, and it is very, very accurate when it comes to liquidity, fair value gaps, and basic market structure. But what if I told you there was a way to, number one, reduce your emotions when it comes to trading ICT? You see, a lot of traders, they'll pick a fair value gap, or they'll take a liquidity sweep and trade the fair value gap after that. And all these things are great. But what you are truly missing is what you see in the bottom right of your bottom right of your screen, sorry. You're missing the idea of order flow. And order flow is the true why behind every single market, right? Be it ES, NQ, Forex, futures. So we're going to be breaking down a 8-part series when it comes to using order flow and how you can integrate that with ICT. And the backbone of this strategy comes down to numbers. And the reason why numbers are so powerful is that numbers are emotionless and you can trade emotionless with them. So stick with me through the end of this first video. So what will be covered, right? So what do we mean by order flow and why is it so important for a trader, right? So traders only ever buy and sell. And what if I told you there was a way to only consider buyers and sellers? You don't even really need most of the ICT concepts, be it time, be it liquidity, be it fair value gaps. Fair value gaps are the most powerful thing. But if you can understand fair value gaps and how you can integrate that with a number-based strategy, that would automatically increase your strike rate and it would automatically reduce a lot of your psychological issues because you are sticking to numbers which are mechanical. So no more getting stopped out or faked out with liquidity or market structure or anything like that, market structure shifts or anything like that. You'll be introduced to the personal platform I use, which is the ATAS platform, right? Why ICT and smart money concepts are often missing the true piece of the market, which is how the markets work. That's again what you see on your screen on the right. The last thing we'll be going over is, and again, understanding why order flow will remove all of the psychological problems you are likely bringing to this video, be it greed, be it FOMO, be it revenge trading, be it whatever it may be, right? Order flow is the answer to all these problems. So what is order flow? Let's get into it. So every candle will have 2 numbers associated within it, which is something that a lot of people don't even know. You have the bid and you have the ask. And the bid and the ask give us 3 very, very important things: the delta, the volume, and finished auctions, which is something we're going to get into now. But think of it this way. The bid represents aggressive sellers and the ask represents aggressive buyers. So if we look over here closely on the screen, you can see that there's 2 numbers in each row, right? 2 numbers and 2 numbers. So let's take this over here. We see 0 for 76. Basic knowledge for this point of the video. The bid is on the left-hand side and the ask is on the right-hand side. So here we see 0 and here we see 76. What this is telling us is that there's 0 market participants that are hitting the bid, right? And there are 76 market participants hitting the ask. So remember, the market is simply an auction between buyers and sellers. It is an auction. And so auctions will only have buyers and sellers in the market. And so our job is to read the auction and understand the auction in terms of the delta, the volume, and finished auctions, which is what we're going to get into now. But for basic knowledge, I want every trader to take away from this slide the fact that the bid and the ask is the only thing you need to be profitable as a trader. Now let's start with the delta. The delta is the easiest to understand. The delta is the bid minus the ask, a simple subtraction equation. So red delta represents a negative delta. So there's more aggressive sellers than there are aggressive buyers. There's more sellers than there are buyers in the present moment. That's simple to understand. Red represents more selling. Quite intuitive. Now blue is the opposite. There's the bid and the ask is a positive number, right? So the bid minus the ask is above 0. There's more aggressive buyers than there are aggressive sellers. And this tells us that, again, there's more buyers than there are sellers, aggressive buyers than there are aggressive sellers, right? That's the basic concept of delta. And the beauty when it comes to order flow is that you're able to visualize this without having to read every single number on the actual charts, right? So you can visualize this. So for example, here you can see 206 and 117. 206 is bigger than 117, we all know that. That's visually represented via the delta profile or the delta footprint. And that's something you see on footprint charts on the ATAS platform, which we're going to get into later on in the video. So that's the delta. The volume is the bid and the ask. So the volume gives you the total number of transactions hitting the markets at that given moment. It's the bid plus the ask, right? So for example, you will see here 21 by 42. So that's 21 hitting the bid. That's 42 market participants hitting the ask. So that's 21 aggressive sellers versus 42 aggressive buyers. Now that will give us a blue delta, which is what you see over here. So there's more aggressive buyers than there are aggressive sellers. But what would the volume be? The delta is going to be a positive number. So the delta there is going to be 21, but the volume is going to be 63 because it's 21 plus 42, right? So the volume is adding them together. Now, what is the purpose of the volume, right? Basic knowledge at this point, you need to understand that when you see low volume, it represents there's less market participants hitting both the bid and the ask. So less volume means less transactions. So when you see the markets moving higher, but the volume is decreasing, this gives us an indication that that move higher may be coming to an end, and vice versa. When you see price moving down, but the volume isn't supporting it, so the volume is decreasing, this could give you an indication that that down move could be exhausted and we could see a move higher. That's basically how we use volume to our advantage. And last but not least, finished auction. So I briefly said earlier that there's a bid and the ask. Now, when there's a zero on one side, what this represents when we see a zero is that the auction has been wiped out and there's no either aggressive buyers or sellers at that point. So if we look over here, we see 28 for zero. This means that there's no market participants hitting the ask. So there's no aggressive buyers, right? This will become very important later on in the series when we start looking at absorption, when we start looking at exhaustion, when we start understanding potential lower time frame reversals, when we start understanding when to enter, when to exit. These things become very important, and finished auctions come in line with the delta and the volume, and we will get into that later on in the series. But for basic knowledge at this point, a 0 on one side means that there's no aggressive buyers or aggressive sellers. The auction is wiped out. Now, this often leads to reversals, and I want traders to think about this. When you see a 0, so let's take this example, this candle over here. When you see a 0 on the right-hand side, that means that there's no market participants hitting the ask. There's no aggressive buyers. So when there's no aggressive buyers and the market moves up, what does that tell you? Well, we're going to go over that later on in the series, so I'll save the answer for later, right? So I use the ATAS platform, like I said earlier, so ATAS. For those who are interested, please check out the ATAS platform. It's simply just a Google search. You can use the ATAS platform, download the ATAS platform, and you will have access to a lot of settings. Now, I will be going over my settings in the next video, but for now, I use the ATAS platform and you have access to the volume, the delta, and bid and ask data. So everything will be there for traders to use. It is a very, very systemized platform, very complex, but you can simplify it for new order flow traders, right? So I use the ATAS platform to trade on, right? So the basics of order flow, let's quickly go over the basics of order flow and why this is an incredibly powerful strategy, right? So if we just look over here, this trade over here, this was around 1 to 3, I believe, where I took profits anyway. So we're in a zone. This is a 15-minute demand area. Again, we'll be going over demand areas later on in the course. We have a demand area. Now, when price comes into a demand, we want to be seeing buyers in control because we only want to be buying when there's bigger players, right? We want to be buying when there's bigger players in line with buying. So the way we do that is by understanding lower time frames. So this is a 15-minute entry. Now on the right, you will see a footprint chart of the exact same price action, but it's illustrated through footprint charts. And you can already see the contrasting differences between candlesticks and footprint charts. Footprint charts allow you to read who is passive and who is aggressive. Now, passive participants, I will briefly explain now. So for example, if we see over here, we have a lot of red delta inside of this demand zone, right? We have a lot of red delta over here and red delta over here, right? You can even read the actual order flow. 40 for 18. So that's almost that's just over a 2-to-1 ratio. There's twice as many aggressive sellers as there are aggressive buyers. Despite that, the market moves up. So what does that tell you about the zone? What does that tell you about this zone? So we have a lot of aggressive sellers coming into this zone. Despite that, the market moves up. So this tells us that buyers are in control. So there's more aggressive sellers than there are aggressive buyers. Despite that, the market moves up. So what this shows us is that there's passive buyers sitting at that level. I'll go through that one more time. We have a lot of aggressive sellers over here. When there's a lot of aggressive sellers trying to move the markets down and price fails to move down, this shows us that there's passive buyers sitting there. So there's more passive buyers than there are aggressive sellers. And this is the true information that gives you the true logic and narrative behind the fair value gap, if it's going to hold or if it's going to break. And this is the true nature of order flow. And this is how powerful it can be. Another example would be this kind of trade over here. This was really, really interesting. where notice how the volume was very low down here. So we had a very low volume and we also had a very low volume over here. So price was moving down, but the volume decreased. Now, when the volume decreases and price moves down, what that means is that the market is less interested in lower prices. There's less market participants that are involved as the market's moving down. So think of it like this. Both the buyers and sellers are thinking, oh, we're not interested in lower prices. I'm not interested in lower prices. And so that is an indication we can read again via the order flow for higher prices. Again, what we saw over here again was very, very interesting. We saw a bunch of aggressive selling over here. The reason this was aggressive selling is again the red delta. Notice how I said earlier, red delta, aggressive selling, more aggressive sellers than there are aggressive buyers. But what's very interesting is that we had a massive impulse over here. You can see this blue rectangle over here. That's 108, a bit small over here, but that's 184 for 2000. So that means we have a very, very large aggressive bias sitting over here, which then caused the move higher. And that's how you could have caught this move over here. But essentially what's happening is we have a bunch of liquidity that's forming over here. We have a bunch of liquidity. The liquidity is correspondent to aggressive sellers that are failing to drive price lower below the zone. So we have a key level, and we're understanding aggressive sellers are struggling. This immediately gives us an indication that we could be looking for buys. Now, what confirmed it is when we saw a very, very large buyer step in over here, 2,000 for 184. So think of that as a ratio, 2,000 for about, let's just say 200 roughly. That is a 10-to-1 ratio. So we had 10 times as many aggressive buyers step in after these aggressive sellers failed. Again, this is order flow being used to its maximum potential. Another example we can go over is this one over here, a selling example. We had a key level up here, 5-minute supply and 5-minute demand, right? We're simply reading the numbers over here. We had 0 for 226, 226 aggressive buyers. Despite that, the zone held over here, and we are simply looking to capitalize off buyer weakness. If lots of buyers are turning up and they're not being rewarded, and price is struggling to break the zone, this tells us that the zone is strong because it is being supported by passive sellers. There's more passive sellers than there are aggressive buyers. And this is the true nature behind the high probability A+ fair value gaps that hold, right? Not the ones that sweep liquidity or break structure. Those things are a byproduct of the order flow, which is what a lot of traders miss out on, right? Another example we'll look at, our last example, is understanding that behind every single trade, there's a level, and the levels are the most important. So I plug these in the free Discord. The link for that will be in the bio. So I plug these in the free Discord. We have ES pre-market game plans over here. Again, pre-market game plans. So I will give a level, and then I'll read the order flow at that level to understand whether to go buy or to go long or short. We have the same thing over here, right? So price is at a supply area. Your job is to patiently wait for sales. Now, what does it mean for patiently waiting? You have to wait for price to patiently get to the level. If we're at a supply level, you want to see aggressive buyers fail to drive price lower, and you take advantage as the level holds after aggressive buyers have been absorbed. Again, we'll be going over this in future videos, but this is the first kind of video in the order flow series. So to sum this up, we have two candles over here, a green candle and a red candle. What's super fascinating is that you have a green candle over here, but what was at the bottom of this green candle? Very, very fascinating. This would be the wick. And a lot of traders don't understand that there's a lot going on behind wicks. When you have a green candle and you have another candle that pushes higher, what's happening over here inside the wick? Well, inside the wick, you have a lot of aggressive sellers, and that's exactly what we had over here. We had a green candle, green body, but inside that we had aggressive sellers, and you can see that via the delta and therefore via the order flow. 433 for 262. That's a 2-to-1 ratio. So you had double the amount of aggressive sellers as you had aggressive buyers. So the truth is you'd have a demand zone over here. This would be a demand area. And you know that the demand area is supported by buyers because there's aggressive sellers that are failing to drive price higher. This is the absorption principle that we will be going over in later videos and tutorials. Then we had the same thing over here. We had 288 for 0. So we had a ton of aggressive selling, but no reward. This tells us that there's passive buyers sitting inside this level. right? So again, quickly going over this trade over here. This was a long trade taken recently. Fantastic. I think this was a 1-to-3 or 1-to-5 risk to reward. Notice how we had a lot of aggressive sellers coming in, aggressive sellers. The aggressive sellers failed. And we also had 94 for zero. Now, 94 for zero means that the auction was wiped out. There were no aggressive buyers and price still moved up. This is a very strong confirmation that there are more passive buyers than there are aggressive sellers. And that is the only thing I use to validate every fair value gap inside of the ES or the NQ market, right? So this is kind of the first of the order flow series, and I hope you all enjoyed it and are looking forward to part 2.